What's up everybody? Thank you for tuning in. I really wanted to make this video because I'm so perplexed at what is happening in the stock market as of late. I mean, the market is on a tear the last few weeks, and I just want to warn people because I can't help but feel bad that some are probably going to be caught in a bull trap. This is not a bull market, friends. We are not out of it. Bear markets last a lot longer than this. We are looking at a 1 to 2 month zoomed in section of the chart of the 2020 economic downturn, which for all we know can last a whole year. Don't pay much attention to the day-to-day or week-to-week. And don't be one of those people who are having FOMO as if you missed the bottom and the market is just going to go up from here. This is why you dollar cost average down so you don't get stuck trying to time the market. I think that's the best way to go about investing during these times. Nobody knows what's going to happen. So if it goes up real high one week and then it goes down real fast another week, it's just a guessing game at this point. Just a quick disclaimer, I could be wrong about all of this. I'm not a financial advisor. I'm just a guy on YouTube just sharing his own thoughts. So let's talk about how we got here. This is a chart of the Dow Jones over a 5 to 6 week period where historically it takes 270 days to fall into a bear market. So it doesn't happen instantly like it did at first. In the short term, the market can have these drastic swings, whether it goes up or down very quickly. And this is what just happened to the market in a matter of 5-6 weeks, from mid-February to the end of March. We went down way too quickly. In that time frame, the Dow Jones went from about 30,000 to 18,340. That's about a 38% decline in a matter of 5 to 6 weeks. Insane. Let's look at the S&P 500 in the same time frame. It went from 3,387 to 2,208. That's a 35% decline. I mean, that's a straight line down. Huge in a short amount of time. But then what happens? The market all of a sudden turns back the other way and shoots straight up. This right here is the S&P 500 in about a 25-day span, going from 2,230 back up to 2,874. That's a 29% gain in just about 3 weeks. Nobody could have seen this coming. Look at the kind of run the market is on. I mean, what is going on in this environment? Dow Jones, same thing, from 18,300 to 24,230, a roughly 32% swing. This is just insane, people. So I just want to slow down for a bit, hit the brakes, and let people know that this sudden surge is not warranted. It's going up way too fast. We have no good news to show for it, and in the last 3 weeks, the market is just doing things that it's almost never done before. I mean, it's just not normal for the market to be this volatile. Markets are not supposed to go up or down 30% this easily. So because of this unique environment that we're in, don't think that you've missed the bottom. All right, this is just a small portion of the bigger picture. Take a step back, please, and let's try to see if we can put things into perspective a little more. So far, the markets have gone into a V-shaped absolute value curve from the good old middle school math days, where it goes down really fast in a straight line and then goes up real fast the other way. I mean, we went from the market going down 32% to now look at the main indexes. Year to date, meaning since the beginning of 2020, the Dow is only down 16%. The S&P 500 is only down 11.76%. Why do we suddenly think that everything is better? Like we're back up and nothing ever happened and this is just a 1 to 2 month blip on the radar? No! This is not how bear markets work. Historically, stocks take 270 days to fall into a bear market, so it doesn't happen fast. The average bear market lasts about 14 months. We are in the early innings, people. Let's just look at the last economic recession back in 08-09 and compare some things. So here's how interesting this gets. If we go back to the 08-09 recession, which, keep in mind, I think what is happening right now is much worse and way more dramatic than 2008. But if we look at this S&P 500 chart of the great financial crisis, there were many times where we saw some nice pickups in the market throughout that stock market crash, which lasted about 1.5 to 2 years. So yes, if you zoom into this chart, of course there are 1 to 2 month stretches where the market is on a run and is just going up. Look at all these green shaped positive slopes. We are in the middle of one of these right now. That's what this recent market run is. Look at how many times it went up just to make a new low further down the line. The amount of chances that you had to buy the dip. So in my opinion, something like this will happen as we go through this market downturn or recession or whatever you want to call it. This recent run that the market is in will most likely not last, as we don't have any real good news or any timetable of when the dust will settle and when we will finally be able to get a clear picture of the impact. This is going to take time. Every person I've listened to that knows what they're talking about is saying how serious of an impact the pandemic is going to have on the US and global economy. Corporate earnings are going to take a huge hit. We will start to get a better picture of how things are as earnings season is upon us and companies are starting to report their Q1 results. So basically, in my opinion, I think we're in the beginning of the beginning. Drawbacks of this magnitude in the economy take much longer than 1 to 2 months. As we mentioned before, the average bear market lasts about 14 months, and in the worst of times, a few years. And even when we are able to defeat the virus and move past all of this, corporate earnings are going to take 1 to 2 years, hopefully not longer than that, to get back to stabilize, to get back to normal. I mean, just look at the numbers and see what's happening. We have never seen jobless claims come in this fast. An additional 5.2 million people filed for unemployment this past week of April 13th. That's 22 million people in the last 4 weeks, just wiping out a decade of job gains. I mean, these are the worst numbers ever. The systems can't even handle the amount of unemployment claims that have been filed. So many people have filed and are just waiting and waiting and waiting. Now, I'm not no expert, but rising unemployment numbers and a rising stock market, that's just a big disconnect there. I mean, what do we think is going to happen? We're going to open back up and then find jobs for 22 million people right away? I don't think that's going to happen. Companies are furloughing workers, and yes, they will bring them back to work as they start coming back online at some point, but they're not all going to come back online, and not all of these businesses will survive, and some that do survive will probably do so with a reduced workforce. It's not just going to be, oh, pandemic's over, everybody get back to work. I think it's going to take a long time to reduce the unemployment rate. This is just a huge hit to the economy. I mean, there's still 20,000 new cases and there's still hundreds of people that lose their lives in the US every single day. So what, we're just going to open everything back up? No, that's crazy. We did a good job of flattening the curve, but now we have to maintain it. If we open everything back up, I think the numbers would increase exponentially right away, and the graph will start heading above the healthcare system capacity, and it would just be worse. People would start dying so much quicker. The death rate would increase by a lot. Hopefully by now you see that there is a very good chance that the market heads back down again. Our economy is 70% consumer spending, and as of right now, the good old high-spending American is stuck at home and not spending any money. This is killing our GDP. Wait until our GDP numbers come in at the end of April. China just announced their 2020 GDP numbers, and they're telling us that their economy decreased by 6.8% in the first quarter of 2020. This is their first economic contraction in 28 years. So 28 years of straight growth until now. And the US economy can potentially be worse off than this. And JP Morgan lowered its estimates, saying that the US economy GDP will come in at minus 10% for the first quarter, and they're estimating that for the second quarter is going to be minus 25% GDP growth. Wow. So tell me again, why is the market up 28% in the last 3 weeks? There are so many macro implications to the nationwide shutdown of businesses and everything that's being caused by social distancing. There are a lot of companies and even a lot of industries that are being impacted that no one is really talking about. One thing that's being overlooked at is the auto industry. Some folks will have trouble making their lease payments or making their finance payments. This can potentially lead to a cluster of loan defaults in the auto sector. The Federal Reserve recently reported that the dealerships are basically, they're almost dead. A lot of them still have their service businesses open because they consider that essential, which makes sense because people are still moving around to some degree, so we need working cars. But as far as the sales go, the Fed report is saying that dealers are expecting March sales to be down from a year ago. Obviously, that makes sense. And for April, they're expecting sales to be close to zero. As seen in this article, many companies are opting to cut salaries instead of laying people off. I have a friend that worked at a really big dealership, and he told me that they laid off 40 people. If you are in the hospitality business, that whole segment has stopped buying. If you are in the airline or transportation or the logistics business, that whole segment has basically stopped buying. We have revenues that will be down in the 90%. The entire retail market is in a heap of trouble. I mean, they already have low margins to begin with. You know, imagine the inventory problems. Stores will close down. Now you get vacancy issues, which then becomes real estate issues as people are not paying their rent, which may affect the real estate owner's ability to pay off their loans, which means we'll probably see a rise in loan defaults in the real estate market. The more businesses shut down, the more vacant real estate we will have, which is obviously not a good thing. And this is what you can do to try to get a macro picture of the overall impact of all this. You have to sort of follow the breadcrumbs and complete a little trace route. I started doing this with a few companies and industries, and it really started to blow my mind the deeper down the rabbit hole I started to go. So here's what I mean. Let's take a random company and complete a little trace route to see everything that is being affected. Let's take a retail business like Macy's, for example. Okay, well, what was Macy's spending money on? They were spending money on people and acquiring customers. That stops. They were spending money on physical plants. That stops. They're going to stop paying the rent. They spend money on merchandise. So whatever they're paying their manufacturers or suppliers, that is going to zero. So the suppliers and the manufacturers are being affected. And that's exactly what's been reported. Manufacturers are reporting that they're really, really struggling. Macy's spend money on point of sale software. That's going to zero because no transactions are occurring in stores. And I can speak from experience because I'm an IT contractor and I've installed plenty of POS systems and registers and POS software for businesses. Nobody's buying POS software or hardware or terminals. If you think of the capital expenditures that those businesses have spent to operate their business, I mean, they've stopped. So my point is that whenever you start to follow the trail of breadcrumbs for any company in any sector, you slowly start to realize that our economy is one big interconnected web of businesses that are all feeding into each other and are all affecting each other. So as much as you might have thought that a company was insulated from what's happening in the economy, I tend to think that what is really going on is not just a sector-based drawdown, but rather there are implications for every single business. I saw a stat the other day that said US domestic box office, so basically movie theaters, this week last year they made $200 million. And this year, for this same week, they made $5 million. I mean, that's a 98% decrease. So just completely being decimated. And you look at something like this and you start thinking, is there going to be an industry that completely evaporates? Because I mean, going to the movies falls into the it's nice to have category. You don't have to go to the movies. And people might be scared to go back after all of this. Because let's be honest, there are other ways you can consume movies. Netflix, Disney Plus, TV, your channel apps. And you might say, oh, Ursi, you're being too pessimistic, too doomsdayish about all of this. But I mean, let's just follow this thinking breadcrumbs and see where this leads. People not going to the movies means businesses like Warner Bros., Sony, Disney, they'll be impacted. The budget and the cost of movies that they're going to make is going to change from now on. As a result, the cost of what they're willing to pay for things is going to change. As a result, the cost of what they pay their employees is going to change. What the CGI maker charges is going to change. So this is why when you have these big cataclysmic economic events, what you have is a period that is very deflationary. A period where prices fall and fall and fall. And because of all the money that the Federal Reserve is printing, a lot of people are concerned with what will happen with inflation. Well, as is typical during a recession, inflation is declining and we are probably at some point going to start seeing deflation, despite all of the money that the Federal Reserve has been printing. A big reason is obviously the super high unemployment rate. Usually, as unemployment goes up, the cost of labor goes down, like we saw with the auto sector, where they're cutting people's salaries. People making less money means people will be spending less money, meaning less demand and cheaper products, which means we get low inflation or maybe even deflation. So there's just way too much uncertainty, and nobody knows what's going to happen because things will take months, if not a year or two, to play out. So don't start developing FOMO and start thinking, oh man, the market was down 30%. So many stocks are on sale. I missed the boat. Because we are going through a very volatile period. And when all of this passes and we look at the current recession chart after a few years, we are going to say, wow, look how many sharp up and down swings we had over the course of this entire economic downturn. Oh wow, here it went back up so quickly in just a few weeks. But then for the next few months, it went down even more and created new lows. Guys, you know how you know when it's really bad? When market-leading tech companies like Facebook and Google start to report negative trends in their business. These companies make a ton of money off of advertising. We are starting to see more and more data come out of advertisement spending being slashed down drastically. Actually, last week, an Expedia executive came out and said, Expedia normally spends about $5 billion a year on advertising. This year, they're not even going to spend $1 billion. So companies that we didn't think were being affected, companies like Facebook, Google, Twitter, even Pinterest, whose half of their revenue is advertising, even these type of companies, it looks like they're going to be affected. Businesses are trying to figure out where they can cut spending. And since advertising is a variable cost, not a fixed cost like your loans that you have to make periodically, no matter what, but ads are a variable payment. Businesses can actually pull that lever and control how much money they are spending on ads. So that is one expense that they actually can control. I mean, even hospitals reported this week that they are losing money. Huh? Reason being is that people are deciding to not go through with or to postpone those elective surgeries. And that's the kind of stuff that is most profitable for hospitals. I mean, you go get ankle surgery, that bill is going to come at least $50,000. More news on how the real estate market is being affected came out this week. Builder confidence is extremely low right now. The National Association of Home Builders Index has seen its largest monthly decline in the index's 30-year history. So if you're still with me and I haven't scared you off, what is the next step? How do we approach investing? There's so much uncertainty. Do you sit on the sideline? What if you miss the boat? Well, first of all, don't panic. You did not miss out. Investing because you're feeling that you're missing out is probably one of the worst mistakes you can potentially make. Keep your emotions out of investing, or try to. I know it's hard sometimes. Become good at conceptualizing time and realize that this is really a short-term thing. This upward trend in the market the last 3 weeks, I think it's really short term. And when this is all over and the dust settles, you won't be looking at a 1 to 2 month chart of the economic downturn, which is all that we have experienced as of now, about 1 to 2 months. Instead, it's going to be a lot larger than that. It's going to be a much bigger chart that might last a year. The full story has not been written yet. I think we will see more dips and you will have more chances to buy on those dips. Earnings season is in the early stages, and finally we'll be able to get a much better idea of how a lot of these companies are being affected by the pandemic as Q1 results start coming out. So do your research, come up with a list of companies that you really want to own and that you really want to add to your portfolio, and then develop a plan as to how you are going to deploy your cash or how you're going to build your position in each of those companies that you want to own. Remember, you do not want to get caught sitting on the sidelines because you are waiting for the bottom. But also, don't try to time it. You can miss the boat that way. Always dollar cost average down. So first things first, research a company well. It shouldn't take you one day to decide that you are investing in it. Investing isn't that simple. There has to be real research done, and you have to build a conviction that this is a good investment. There's a famous saying in real estate which says, you make your money when you buy. Which basically means the real way to get massive returns is to buy low, to buy at a discount, to buy cheap. So ideally, everyone wants to buy at the bottom. But buying at the bottom is nearly impossible because nobody knows when the bottom will be. If they tell you they know, then you should probably run the other way because there's no way the market can be predicted. Trust me, smarter people have tried. So how do you proceed? Well, an irrational investor might say, I'm going to wait to get it real cheap at this certain price and I'm only going to buy my position then. But if you do this and the stock never hits your price target and instead it goes the other way and it goes up, now you have just missed out on it and you're starting to kick yourself because you never got in. So that's not the right way to do it. There is a better way to do it, and then there is the best way to do it. The better way to do it is thinking, this is a really good company. It's going to be around for the next 10 years. They will readjust and come out of this pandemic just fine, and they'll still be around the next 10 years. So you know what? I'm just going to buy it whatever price it's at now and just hold for the next 3 to 5 years to 7 years. You can do this, and in my opinion, this is a really good way to do it, especially if you have a multi-year horizon. But the best way to do it, in my opinion, is to dollar cost average down. It allows you to build your position in a stock so that you can sort of cover yourself on both sides. You should always be thinking, how can I invest in this stock such that I lower my risk if I buy it and it goes down? Well, you don't buy all at once. If you use only 1/4 of the money that you allocated for that certain position and you buy some of it and it goes down, well, that's okay. You can buy some more at a cheaper price. And if it goes down from there, you buy even more at an even cheaper price. So this is the best way to try to buy as low as possible without falling for the trap of trying to time the market. It's just less risky. You make sure you are in the boat just in case it takes off and the stock starts running up and now you have some profit. And if for some reason it goes down, well, it's okay. You're not going to be down a lot because you didn't throw all your money in it at once. So this is how I'm investing. Now I want to turn it over back to you and ask, what do you think is going to happen to the stock market and the economy? Is it going to have another crash? Will investors have another chance or other chances to buy stocks at lower prices? Please let me know in the comment section below, and if you enjoyed this video, please tap the like button as well as subscribe to the channel. Until next time.